You dedicated decades of your life to teaching classrooms, running into burning buildings, or keeping your community safe. You paid into a pension system. You never paid into Social Security. For years, the federal government reduced your Social Security payment because of two rules known as WEP and GPO. Then in January 2025, Congress voted to repeal both of those rules entirely. The government acknowledged it owed you money and delivered it. The average retroactive payment came out to approximately $6,910 deposited directly into bank accounts across the country. People thought to themselves, finally, this is justice. This is the money that was wrongfully withheld from me for years. Then tax season rolled around and the IRS presented a bill because that $6,910, the money you were rightfully owed, is counted as 2025 income. And for millions of retirees, that single deposit pushed them past the threshold at which Social Security benefits become subject to federal taxation. Nobody warned them in advance. Nobody told them about the one specific IRS calculation that could have significantly reduced that tax burden. Today, we are going to walk through exactly what happened and precisely what you can do about it right now. Today, we are covering the Social Security Fairness Act, the Backpay tax trap that caught so many people off guard, the IRS Lump Sum Election that the overwhelming majority of seniors have never heard of, and 3 concrete steps you can take immediately to protect yourself. Consider someone we will call Richard. He is 69 years old. He spent 32 years working as a public school principal in Illinois. His school district was not part of the Social Security system. Instead, he contributed to the state pension program throughout his entire career. When retirement arrived, his Social Security benefit had been heavily reduced under the windfall elimination provision. He was receiving $480 per month rather than the $1,340 he had actually earned based on his work record. For 6 years, he accepted that reduced amount. He believed it was simply the law and that nothing was ever going to change. Then, in January 2025, the Social Security Fairness Act was officially signed into law. In March of that year, a deposit of $6,910 appeared in his bank account. Those were the retroactive payments covering January through December of 2024, the year in which WEP and GPO were formally eliminated. His monthly benefit also jumped from $480 to $1,290 beginning in April 2025. Richard was overjoyed. He told his wife that they were finally receiving what they had always deserved. Then, in February 2026, Richard sat down to prepare his 2025 tax return. When he added everything together, his pension income plus his new higher Social Security benefit plus the $6,910 lump sum combined to push his total income above $34,000. For the very first time in his entire retirement, up to 85% of his Social Security benefits became subject to federal taxation. His tax liability increased by more than $2,100. Richard had absolutely no warning that this was coming. He had never been told about the IRS Lump Sum Election, a specialized calculation that could have meaningfully reduced his taxable income and his tax bill. He paid the full amount. That money is permanently gone. Today, we are going to make sure you know what Richard never had the opportunity to learn before it was too late. Let us start with what the Social Security Fairness Act actually accomplished. On January 5, 2025, President Biden signed the Social Security Fairness Act into law. This legislation eliminated 2 provisions that had been embedded in federal law since the 1970s and 1980s. The first was the windfall elimination provision, which reduced Social Security retirement and disability benefits for individuals who also received a pension from employment that was not covered by Social Security. The second was the government pension offset. which reduced or eliminated spousal and survivor Social Security benefits for that same category of workers. These two provisions had impacted more than 3.2 million Americans, primarily consisting of teachers, firefighters, police officers, federal employees covered under the Civil Service Retirement System, and certain workers whose careers included time working outside the United States in positions not covered by Social Security. The Social Security Administration moved quickly to carry out the requirements of the new law. By March 4, 2025, more than 1.1 million people had already received their retroactive payments, with the total amount distributed exceeding $7.5 billion. The average retroactive payment received by individuals in that group was $6,910. Monthly benefit amounts for the majority of affected retirees were increased beginning in April 2025. This was a genuine and long overdue victory for millions of public servants who had been receiving less than they earned for decades. But it arrived accompanied by a tax consequence that most recipients never anticipated and never received any warning about. Now let us address the tax trap and explain why the IRS is collecting taxes on your back pay. Here is the rule that caught so many seniors completely unprepared. The approximately $6,910 average retroactive payment is treated as ordinary income in the calendar year it was actually received. For the overwhelming majority of recipients, that was 2025. It does not matter that the money represents benefits that relate to the year 2024. It does not matter that it constitutes money that was wrongfully withheld from you. Under IRS rules and regulations, it is 2025 income, and it is taxed accordingly as 2025 income. Now here is why that classification creates such a significant problem for so many people. Social Security benefits become taxable based on a figure the IRS refers to as combined income. Combined income is calculated by taking your adjusted gross income, adding any tax-exempt interest you received, and then adding 1/2 of your total Social Security benefits for the year. For individuals filing as single taxpayers, if combined income exceeds $25,000, up to 50% of your Social Security benefits become taxable. If combined income exceeds $34,000, up to 85% of your benefits become taxable. For married couples who file jointly, those two thresholds are set at $32,000 and $44,000 respectively. Here is the detail that makes this situation particularly damaging. These income thresholds were established in 1984 and have not been revised at any point since then. They have never been adjusted to account for inflation. They have never been updated to reflect the annual cost of living adjustments applied to Social Security benefits over the decades. They have not moved by a single dollar in over 40 years. Back in 1984, only approximately 10% of Social Security recipients were required to pay federal income tax on their benefits. Today, because benefit amounts have grown substantially with inflation while the thresholds have remained completely frozen, approximately 40% of Social Security recipients now pay federal income taxes on their benefits. And for the millions of seniors who received a lump sum retroactive payment in 2025, that single deposit was enough to push them over a threshold they had never previously crossed, generating a tax bill they had never anticipated on money they had been rightfully owed for years. Now let us talk about the IRS Lump Sum Election, which is the protection that the vast majority of seniors never learn exists. Here is the critical piece of information that Richard never had access to. The IRS has a specialized calculation method designed specifically for circumstances like the ones created by the Social Security Fairness Act Backpay distributions. It is formally called the Lump Sum Election. The full explanation of how it works is contained in IRS Publication 9.1 which is titled Social Security and Equivalent Railroad Retirement Benefits. Here is how the calculation actually functions. rather than treating the entire retroactive payment as income received in 2025. The lump sum election allows you to calculate your tax liability as though the back pay had actually been received during the years to which it properly belongs. In Richard's specific situation, his $6,910 payment covered the period from January through December of 2024. By using the lump sum election, he could calculate his 2025 federal taxes as if that money had arrived during 2024, when his overall income was lower and he was still below the Social Security taxability threshold. If that alternative calculation method produces a lower tax liability than the standard method, the taxpayer is permitted to use it instead of the default calculation. The critical point to understand is that the IRS does not apply this calculation automatically on your behalf. You or your tax professional must actively and intentionally select this method when preparing your return. And the reality is that most seniors and even a significant number of professional tax preparers are completely unaware that this option exists. If you received Social Security back pay during 2025 and you have already submitted your 2025 tax return without utilizing the lump sum election, you may have the ability to file Form 1040X, which is the amended individual income tax return, recalculate your liability using this method, and potentially receive a refund for the difference. The deadline to file an amended 2025 tax return is April 15, 2029, which means time is still available to pursue this correction. There is a second protective tool available that could further reduce or potentially eliminate the tax impact of your back payment entirely. As has been covered in previous discussions, the One Big Beautiful Bill created a new $6,000 enhanced deduction available to seniors who are 65 years of age or older, and this deduction applies to tax years 2025 through 2028. This deduction functions by directly reducing your taxable income for the year in which you claim it. If claiming the $6,000 deduction brings your combined income figure below the $25,000 threshold for single filers or below the $32,000 threshold for married couples filing jointly, it could eliminate the taxability of your Social Security benefits completely for that year. What that means in practical terms is that the back pay tax trap created by the Social Security Fairness Act distribution could be fully and completely offset by this deduction. For seniors whose income levels are in the range near those thresholds, this deduction is claimed on Schedule 1A when filing Form 1040 or Form 1040-SR. If you submitted your 2025 tax return without claiming this deduction and without applying the lump sum election, there is a meaningful possibility that you significantly overpaid your federal income taxes. Both of these issues can be corrected and addressed through the amended return process, and both corrections can potentially result in a refund being sent to you. There is one additional layer to this situation that deserves attention because federal taxes are not the only financial consideration involved. The majority of states that impose an income tax also tax Social Security benefits, to at least some degree. However, the landscape at the state level has been shifting in recent years. Kansas, Missouri, and Nebraska each eliminated their state income taxes on Social Security benefits during 2024. West Virginia completed that same elimination in 2026. If you are a resident of one of those states, your back payment may be partially or completely exempt from state-level income taxation. But if you reside in a state that continues to tax Social Security income, the retroactive payment adds to your state tax burden as well. To find out precisely how your particular state treats Social Security income, you can check directly with your state tax authority or consult AARP's State Tax Guide available at aarp.org. Here are 3 specific steps you need to take right now. Write these down so you do not forget them. Step 1 involves checking your 2025 tax return to determine whether the lump sum election was used. If you receive Social Security back pay during 2025, locate your 2025 federal tax return right now and examine how the retroactive payment was reported and treated. If the tax preparer who handled your return did not apply the lump sum election method described in IRS Publication 915, your tax liability may be higher than it legally needs to be. Go directly to irs.gov and search for Publication 915. Within that publication, locate Worksheet 1 and Worksheet 2, which are the specific computational tools used to determine whether the lump sum election produces a lower tax outcome than the standard method. If you are not comfortable working through this calculation on your own, bring your tax return to an AARP Foundation tax aid location where this service is provided completely free of charge. You can reach them by calling 888 AARP now, which is 1-888-227-7669. When you call, explain that you received Social Security back pay during 2025 and that you want to verify whether the lump sum election applies to your specific situation and whether it would reduce your tax liability. If the recalculation using the lump sum election produces a lower tax figure, proceed with filing Form 1040-AX to amend your 2025 return and claim the resulting refund. Step 2 is to claim the $6,000 enhanced senior deduction if you did not include it on your original return. If you are 65 years of age or older and you did not claim the enhanced senior deduction when you filed your 2025 taxes, you left a significant amount of money on the table unnecessarily. The $6,000 deduction per eligible individual works directly to reduce the combined income figure that determines what percentage of your Social Security benefits are subject to taxation. For many seniors, claiming this deduction eliminates the taxation of Social Security benefits entirely for that tax year. File Form 1040-X to amend your 2025 return and attach Schedule 1A to claim the deduction you missed. This amended return can be submitted electronically through irs.gov. You have until April 15, 2029 to complete this process, but every month you delay is a month longer before your refund arrives in your account. Do not put this off. Step 3 is to establish voluntary tax withholding on your future Social Security payments going forward. Now that your monthly Social Security benefit is higher as a result of the Fairness Act, and now that your income may consistently remain in taxable territory for the foreseeable future, it is important to set up a mechanism for withholding federal taxes from your monthly payments rather than facing a large and unexpected bill each April. The form you need for this purpose is Form W-4V, which is the voluntary withholding request. Using this form, you can elect to have 7%, 10%, 12%, or 22% of your monthly Social Security payment withheld and applied toward your federal income tax obligation throughout the year. You can download Form W-4V directly from irs.gov. Once completed, the form should be mailed or faxed to your local Social Security Administration office. Alternatively, you can contact the Social Security Administration directly by phone at 1-800-772-1213 to request the form and receive assistance with the submission process. Taking this one straightforward step now will prevent another unwelcome and stressful tax surprise when you sit down to file your 2026 return in April 2027. The Social Security Fairness Act represented a genuine and meaningful victory for millions of dedicated public servants, the teachers who educated generations of young people, the firefighters who placed themselves in danger to protect others, the police officers who served their communities, the federal workers who spent their careers in public service, all of whom were penalized for decades by two provisions that never should have been allowed to stand for as long as they did. Every dollar of that retroactive back payment was deserved and long overdue. But the tax system created a trap around those payments that no one thought to warn recipients about in advance. and the tools that exist to reduce or entirely eliminate that tax burden, the lump sum election, and the $6,000 enhanced senior deduction are available right now to help correct the situation. Most people simply do not know these tools exist or how to use them. That is precisely the reason this type of information needs to reach as many people as possible. If you know a retired teacher, a former firefighter, a police officer, a public servant of any kind who received Social Security back pay in 2025, please share this information with them directly. They may have filed their taxes without applying either of these protective measures, and they may still have the opportunity to amend their return, recover money they overpaid, and protect their financial security going forward. Stay informed and protect every dollar you have rightfully earned.